My kids love these videos, and I've always wanted to say that.
There you go. Welcome back to another episode of Gulf Coast Investing, where we talk about all things investing right here on the Gulf Coast. My name is Casey. I'd love if you would hit the subscribe button and like this video to see more great content. So today I am here with my good buddy, Chad Hampton. Wanted to bring him on to talk about the mortgage and the loan side of investing in investment properties and all that. So that's what we're going to get into today. So I guess first, if you want to introduce yourself, tell everybody a little bit about yourself.
Thanks, Casey. I'm actually really excited about being on your channel. I like watching it. So I'm kind of like.
Yeah, you're like the first guest. So like long term, we want to have a bunch of guests on and all that. So you're like the first one.
I'm fanning out right here. So I'm Chad Hampton. I work for Movement Mortgage. I do lots of investment loans. Being that I'm here at the wharf in the Gulf Coast market, the Orange Beach Gulf Shores, in the Perdido here market. We're on an island with 21,000 full-time residents and about 6.1 million visitors a year.
Crazy.
So we do lots of investment loans because everyone here is either, pretty much, is either buying an investment property or a second home, but primarily people are looking for rental income. Yep. So it's a major piece of what we do. Yeah.
And kind of cool because he won't toot his own horn, but Chad's won all kind of Rookie of the Year stuff years ago, and I was just looking at all the trophies, and him and his partner, they do just awesome work down here. One of the biggest movers and shakers in the condo market down here, so it's awesome. So I guess kind of the first thing I wanted to talk about is obviously, we talk a lot on this channel about people that are buying an investment condo, home, whatever that is. People need to know, well, what's the first step, which we always tell people, well, you need to go, if you're not paying cash, which if you don't have $1 million sitting in the bank or whatever, if you're not paying cash, what's the first step, which is to go get pre-qualified and all that. So kind of talk us through what's the first step when somebody comes to you and says, hey, I want to buy an investment property. What are you kind of looking at? What are you needing from them to get the process started?
Yeah, great question. So first question, is this a 1031 exchange? So lots of people buy real estate, it appreciates, they make some money on it, they sell it, they flip it, and they either convert it into a bigger property or multiple properties lots of times, so they don't have to pay the capital gains taxes on that. It's a very beneficial way to cut into a down payment instead of paying the IRS, So,
especially people this day and age that may have a lot of equity and all that.
That's right.
They don't want to pay a big tax bill, so they're just going to 1031, roll it to a new deal.
Yeah, I mean, we're seeing lots of people who bought a condo, say, 2020, 2019, 2021 even. Yeah. And they're like, hey, I've made a bunch of money on this one. I'll take a cash out refi, get a down payment, or I've got a little bit more money here. Let's go do another one. Or let's sell this one and turn it into two units or whatever. So seeing lots of stuff like that. But yeah, the first thing is we want to figure out the overall goal of what they're trying to do. Is this a property that I want to take as a second home and use for my family, but also earn some rental income because occupancy rules allow you to do that. And then, or is it a pure investment property? That's all. That's what this is for. And then really the differentiating factor there is how much you're going to use it and how much you're required to put down as a down payment. Up until about, I'll say, a year ago roughly, there was a pretty significant difference in interest rates between the two. Yeah. But Fannie and Freddie have changed a lot of rules, and they're doing so again now, which we can talk about at some point. But adding these things called LLPAs, which are loan level price adjustments, which affect the rates on the second homes, and they're pretty much priced the same. So now it's how are you going to use the property. But yeah, with an investment property, you can go as little as 15% down. Second home, you can go as little as 10% down. There will be discount points involved at that level of down payment. The sweet spot is if you can get to 25% down, you get all kinds of options. Yeah. But yeah, that's the thing. So that happens, and then if you're using an investment property type of loan, you don't even actually have to have the income to support taking on the additional mortgage, because you can actually use 75% of the gross rental income that the appraiser finds for the market value and puts on the appraisal report. So that can help you qualify there.
And that's what one thing I think is big that so many people don't understand is, if you're buying a house, you have your debt to income ratio, you have all these things to worry about. If you want to go buy a second house just to live in both houses you're living in theory, well, then that one's going to also have to qualify for the same thing. Yes. But if you're buying it as an investment, then there's other factors like the DSCR loan where it's actually factoring in the income that the property's bringing in.
Yeah, so
which is awesome.
That's a great point. So a regular investment loan, you can use, like I said, 75% of whatever the appraiser determines the market value to be on the appraisal report as qualifying income. A DSCR loan, that's all you have to worry about. Does the property have income generating potential to offset the PITIA, basically the expense, the monthly expense of owning the property? So if you can generate enough rental income to offset what the property costs, that's all you have to worry about. I mean, obviously you have to have a credit score high enough, but credit requirements on DSCR loans are not that high. Actually, they're much lower. I mean, they're very reasonable. So that being said, they're much lower than you would think. So those are really, really exciting loans. Now the trade-off, your interest rate's not going to be as good as if you did a typical investment conventional type of mortgage, but
for people that are just getting started and maybe don't meet certain requirements or all that and want to get into it, then paying a little bit more, it gets you in the ball game.
Yeah, and it's actually a sophisticated product because a lot of people that use it have lots of properties. Yeah, honestly, and that they look at it at a cash flow basis, right? So they're looking at can I make money on this, and then factoring in the fact that the property is typically going to appreciate over time. Right. You can always get in with this one and then refinance it later into a lower interest rate type of product and improve your cash flow. But like honestly, a lot of people that do DSCR loans already have multiple properties, and I mean they understand that all you have to do is be in the green, right? And it makes sense. So because you're appreciating most likely too. So and then there's tax benefits involved with investment properties, which I know you're well aware of that, and this is what this channel's for, is to learn about these types of things. But if you can get a property there that's going to make you some cash flow and then also give you tax benefits, it's the fastest way to accumulate wealth over history. Anyway. Right. Anyway, yeah.
Yeah. No, I think that's awesome, and again, that's why I wanted to have the expert on talking about those different things. Talk real quick about. I know it's a little nitpicky, but if you're going to get an investment loan versus a second home loan and kind of what that means, because some people may say, well, I want it to be a second home or an investment, things like that.
So I always evaluate it both ways if the person is planning to use the property themselves. That's the first thing. You have to determine what their intended use is, right? Yeah. So, that's the thing. The difference is minimum down payment is about 5% higher on the investment loan side, and you're allowed to use the income that it can generate to help you qualify 75% of whatever the appraiser determines. Yeah. Where second home, you're not allowed to do that because it's supposed to be a second home, right? Now, can you rent it? Yes, you can. There are rules around that, but you can. And then other than that, really most of the other rules are not that different than when you're buying a house to live in. I mean, so none of that really matters. The DSCR is purely an investment loan, so obviously you're looking that way.
And so that's what's cool too is like we get so many people that obviously 6 million plus people visit down here. They're probably paying, and then we actually get. I mean, when we used to live up in Birmingham, we would come down 2-3 times a year. Right. Well, you add all that up, and I may spend. Somebody may spend $10,000 a year just in vacationing down here. So now if I have an investment property, not only am I getting income, but now I just saved myself, in theory, $10,000 that year. And even if I'm kind of breaking even because the interest rates are a little higher or the prices are a little bit higher, even if I'm breaking even, well now, like you said, I get the tax benefits from the write-offs and all that of, hey, I get a second home or I get an investment property. Now I have somewhere to stay, and I'm saving myself money, not having to pay for a place of vacation every year.
Casey, we see lots of people who will buy a property, whether it be condo or a house, it doesn't matter. They'll rent the thing for several years. In that time, the renters are paying down your mortgage, right? Yep. So you're gaining equity. The property is likely appreciating, so you're gaining more equity. And then what they'll do is they'll take a cash out refi, take some of their cash back, go buy another one. Now they have 2 income sources and 3. And over time, these things build up, and then people make some significant money that way.
And that's what's awesome about when they do the cash out refi. You're getting the money out, but it's tax free. So and that's how how they say how the rich get richer is they're taking their money, and instead of selling and just putting the profit into their pocket, which is going to get taxed, no, they're going to refinance it, take that cash out, take that cash and go put it into another property, and now they have now it's tax free. They're getting to roll their down payment and all that.
That's a valid point, and a lot of people fund retirement that way, or make it kind of like a self-funded pension type of thing, right? Where they have multiple properties, income streams, cash flow coming in from these properties, these rentals that they've had over time. It's good. It's a good thing. So now there are differences in condo loans as compared to single family or 2 to 4 unit duplexes, triplexes.
Yeah, that's what I was going to say. Talk about, because condos down here are crazy. We always tell people when they're coming, there's some condo complexes where each building is under different rules and guidelines. So talk a little bit about, what that, I know that it's a whole can of worms, but kind of what you may want to look for, some differences if you're just buying a house versus buying a condo.
Sure. So we do over 100 condo unit loans a year in this office. So we're pretty well versed with that. Yeah. We do investment properties of all types, all over the place, though. I'm not gonna completely let you in on all the secret sauce, but yeah. So the difference is let's take a single family home in Mobile or Foley or Jackson, Mississippi, or Chattanooga, Tennessee. Yeah. So those are all going to be just like I talked about before, just basically like you're buying a house for yourself, except for you're having to qualify for the extra payments, right? Right. And again, you can use the appraiser's market value analysis for part of the income, and that usually is all it takes, not a big deal. So a condo, and specifically a resort area condo, resort properties have different rules by Fannie and Freddie. They're much more stringent. So you have to qualify the person just like that, like everything else, but then you also have to qualify the building, the development. So let's take a Phoenix, for example, right? So there are, I don't even know offhand, 12 or something. I don't know, lots of Phoenixes.
Like 20 something now, I think. It's crazy.
Yeah, well, I just meant right here in Orange Beach. Yeah. But yeah, so you have to qualify that specific building, right, plus the person. So what we do is we have a condo underwriter and a condo group who works on the building while we're working on the person, right? Yeah. So we do them in parallel, and that's why we can still meet a 30-day or whatever contract. Fannie and Freddie make you do stringent requirements on resort area condo, and they make you check out all the governing docs,
the budgets I know they're looking at, so and the reserves.
Correct. And so the thing about that is, as a buyer, as an investor, it's actually, it's red tape, but it's actually in your benefit, because what we're doing is we're verifying that the health of the HOA financially and legally, like insurance requirements, is something that you would actually want to own. So you want to make sure it's being run properly so that you're not at a financial disadvantage later, right?
That's what, you always see, like, obviously the mortgage company, if we have a cash buyer, all that due diligence, a lot of that they're having to do themselves and find out, hey, what's this and that. Where the good part is, a mortgage company, they're not going to give you a loan unless it's a good deal. Yeah. So if they tell you no, it's not a good deal, well, it ends up saving you. That means it's probably a good thing you didn't buy it because of different factors.
Yeah, and so like a point you made earlier, right? come to a mortgage lender early, right? Let us evaluate it, because we can tell you what we know about the particular building. While you're going to look at condos, we can be like, okay, yeah, this one, and this one are probably good. This one's going to be more difficult. They have problems with XYZ. Maybe it's liens or litigation, or maybe they don't have enough fidelity insurance,
right?
Insurance against crime.
I was talking to an agent the other day, and they were talking about a certain condo down here that may be getting hit with a huge assessment, and I'm like, for agents, you need to have yourself a good mortgage person that knows. Like, you wasted your time pretty much. I mean, your buyer, if he's paying all cash, you get a good deal for some of these, but it's like, you're wasting your time because you could have just called a mortgage guy. You could have called Chad. He'd have told you, well, get ready for a huge assessment, this, and you wouldn't have wasted your time showing the property. So
we field a lot of questions like that. We're very, very happy to help those scenarios. So, but yeah, that's what we do. We look at the budget. Do they have adequate reserves? Which typically you want like 10% of whatever the operating income, the HOA annual income is. So, do they have good reserves? Do they have adequate insurance? All the things in their governing docs that they say they're supposed to be doing. Are they doing those things? You evaluate the occupancy of the building. How many investor properties? How many primary or second?
Some that are like timeshare, big timeshare buildings.
Correct. Correct. So we check all these things out for you. Look at all the budgetary line items and make sure that they all meet what Fannie and Freddie like. And then we look at assessments. We look at is there deferred maintenance? That's what happened with that condo in South Florida that caused all the problems. They deferred maintenance, and all of a sudden it collapsed. So like we look at all these things. Matter of fact, now we even review the meeting minutes from HOAs just to make sure that there's not an assessment coming that the owners don't know about. Right. So you don't want to buy this. Well, you may, but you may not want to buy this property and then find out
the next day you get hit with a $20,000 bill.
Yeah. So we look at all those things and we make sure that it's healthy. And so the thing is, like, if we find something that's deficient, we don't just say, hey, we're not doing it. What we do is we usually work with the HOA or the property manager or whoever is the contact point there, and say, hey, look, we recommend to meet Fannie or Freddie's minimum fidelity insurance, you need to add a little bit more coverage. Or, hey, if you had a little bit more in next year's operating budget, if you put a little bit more in reserves, then you could do XYZ,
right,
or whatever.
And it'll help the property sell for more money, which means property prices are going to increase, and it helps the whole building out.
So. So it opens the sellers or the owners up to a larger potential buyer pool because people could get conventional financing.
Yeah.
So we try to help, because if every building, if every condo is in good shape with Fannie and Freddie, then more people have options, more people have access to them. It's good for everybody, right? So that's a great question.
Cool, awesome. Well, I know there's so many other things to get into, so we're obviously going to have you back on to go over different things like that. Anything else you want to talk about? We'll wrap up this one for kind of part one.
So one thing, there are lots of duplexes and things like that along the beach here too, and those are a little different. You do need typically for a multi-unit, you do need like a 25% down payment, but those are interesting to talk about too, because a lot of those are zoned as condos. So there's some interesting things here there too. Thanks for letting me on.
Definitely
glad to meet you guys. Please like and comment below, because my kids love these videos, and I've always wanted to say that.
There you go. All right, well, thanks for coming on, and we'll see you next week.
Smash the like button. That's what my kids like.
Smash it.